have been nice if it had been the other way around, just for a bit of action.
Yes, of course.
Region heavily supporting Iran, obviously, just because geographically they're in our space. But yeah, interesting. Great. Well, I think we're going to go live in less than a minute. So, here we go. We're already 10:30. And do we have Robin? Let's see. Okay, well, he can join us when he joins us. He's still not responding, apparently. 1 second. But he has given a thumbs up. So we're going to get going and hopefully he will join. Maybe he's having some technical problems. Good morning and good afternoon to some of you, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is the last day of November. We're almost at the end of the year and ahead of the season to have a break for most of us, hopefully. So we wish everyone the best there. But let's look ahead, and we've got a really, really busy podcast this morning, a lot to talk about. I'm delighted to be joined by Peter McGuire, CEO of XM Australia, and Clyde Russell, Asia Commodities and Energy columnist at Thomson Reuters. And we will be hopefully being joined by Robin Mills from Qamar Energy in the next few minutes. But there he is. There's Robin. Good morning, Robin. Just on time.
Hello. Good morning, everybody.
I was going to go to you first, Robin, but I'll give you a minute to settle in. Let's go to you, Peter, for an outlook on all things sort of prices, commodities, US economy. We're expecting some speech later today from the US on the sort of the proposed next rate hike, which is expected to be 50 basis points. What's the point of view from where you are in Australia, but again, on the sort of latest feeling of where the US economy is at for next year in light of Fed policy?
Well, Diallo, I tell you what, it's and welcome to everyone, and hello and greetings from Sydney. Here we go, and it's certainly showtime. The market hasn't disappointed over the first 11 months, and as we bed into December, and we look forward to seeing what the Fed's prepared to do, and 50 basis points seem to be pretty much, the line in the sand. The 50-50 toss of the coin as far as a recessionary fears in 23. So that's where the pundits are saying. So it's an even Steven situation moving forward. And how aggressive is I suppose the equity market rally? Is that going to continue over the next couple of weeks leading into Santa Claus? And maybe it's already started, but I think it's still pretty washy. And then commodities, if we look at the energy sector, and I'm with a couple of experts here, they've been massively sold off, the energy sector. Well, certainly crude has been, and US dollars capitulated. So it's just been an enormous, the last, I'd say 2 months have been absolute showtime for retail traders globally. With that US dollar capitulating, we've had a new prime minister, we've got a new king, we've done a lot of global themes going on, and the uncertainty in China is creating much angst, I think, on Main Street and certainly from retail market sentiment. So Diala, all I'll say is this, strap yourself in, because I think it's going to be one bumpy ride.
Yeah, okay, well, so it's a very balanced outlook there, right? I mean, the volatility is here to continue by what you just said. It could really go either way, 50-50 on all those points you touched, commodities, equities, again, the outlook for the next 6-12 months, who knows? The only thing that seems to be certain is the Federal Reserve policy, which is kind of indicating pretty clearly, Peter, just staying with you just for a second,
yes.
That next year is likely to be sort of this whole longer rather than higher policy in terms of rates, right? So keep them going up, but not so high. Does that seem to be absorbed now into sort of everyone's considerations?
Well, it's if the inflation number is manageable, and we have seen the headline, we've seen peak, then it starts to trim back from here. Then Diallo, I'd say the answer would be yes. It's going to those little rate rises and possibly even some form of softening, or let's just see where we are by this time next year. But if the inflation rate hasn't hit the moon yet, then that's going to create much angst. And this is very much a week by week, month by month proposition. And I'm really looking forward to hearing Fed, but more importantly, NFP this Friday, non-farm payrolls, and what the situation is as far as US leading into, of course, this Christmas season.
Yeah, and of course, the employment figures are going to be watched very closely as we go into next year. And, you know, whether inflation, there's still a panic over inflation or not, that seems to be dissipating a bit. Clyde, Russell, let's go to you. Thanks again for joining us. Let's talk a bit about China. Peter mentioned it there, of course, one of the big elephants in the room, and that is China, Chinese economy, Chinese demand. Of course, we're talking about energy in principle on this program. Give us a bit of an outlook, in your opinion, for the, let's say, the first half of next year. You don't know what's going to happen with their COVID policy, but given what we've seen recently with protests and the pressure that's piling on there on the government, what difference do you think it'll make if China does ease its COVID lockdowns in terms of demand?
I think if we if you sort of try to read between everything that the noise of the media, it's quite clear that the authorities in Beijing want to ease as much as they possibly can without letting this COVID run rampant and put pressure on their public health system and cause fatalities, particularly amongst the elderly. So there's a desire to ease restrictions and kickstart the economy. The question always is going to be, will that actually happen? There's two things that they can't really tolerate. One is open displays of dissent. So I imagine that if those continue, that you will see a harsher response, and that's obviously not good for the economy. That's the one aspect. The other thing is they can't tolerate high rates of infection. Perhaps Western countries have learned to live with it. Certainly the Western vaccines appear to have been more effective than the Chinese ones. So there is that sort of uncertainty. That said, if you're looking at the first half of next year, if you can reach some kind of accommodation where COVID is kept under control, but the economy opens up, and we're now actually seeing what I would term meaningful stimulus put into the economy, like $160 billion worth of new loans into the property development sector, things like that. That speaks to quite a positive outcome. China's in a very different spot to virtually everywhere else in the world. They don't really have an inflation problem. They have an economic growth problem. So I imagine that that's what they'll be looking at. So I would expect that things will get better in the first half of next year, with that a caveat that they can manage COVID, that they can manage the social unrest without things getting out of hand.
Okay, great, Clyde. And we'll come back to you on terms of, okay, if that happens, then what? What's really going to happen to the Chinese economy as a sort of, what can we assume its demand will be if everything improves to an extent? Robin Mills, welcome again, Robin Mills, CEO of Tamar Energy. Robin, lot to ask you this morning as well. Let's pick up a little bit on the China angle first, but and talk about OPEC Plus. They're planning, obviously, to have now a virtual meeting on Sunday. A, what does that signal? Does that signal that we know what they're going to do already and they don't have to meet in person? And B, how much is the China factor factoring in to their decision for next year?
Yeah, so thanks, Diala. Hello, everyone. So I think the switch to a virtual meeting, so it's not expected to be a controversial meeting. I think that would weigh things towards a rollover. No cuts. There was some kicking around some idea of further cuts of the past week or so, but probably that's off the table. Prices obviously been down a lot over the past couple of weeks, but now bouncing back a bit, probably enough to give them comfort that a rollover is okay. Although never all a surprise out. But I think that's it. He's tilting the balance towards just keeping production steady. And of course, this is just ahead of the EU, of the coming to force of the EU ban on Russian oil. So that's already starting to have an effect in terms of people looking forward to purchases. But we won't start seeing the full effect until we get well into December. But obviously,
we won't see that effect, obviously, from the Russian embargo. But if OPEC had to guess at what the effect will be in the first quarter of next year, what is their thinking, do you think, today? Are they actually worried about Russian production being impacted negatively in terms of how that might impact their policy on increasing production again?
I think on that they're in a wait and see, and it's difficult for them to get ahead of the situation because obviously Russia is a member of OPEC Plus. So if they were to make quite aggressive assumptions on cuts in Russian exports, then Russia has got its vote at the table and will object to that. So it's pretty difficult for them to act, I think, until they actually see incontrovertible evidence that a lot of Russian crude is being taken off the market by these measures. And we've had repeated predictions that a lot of Russian oil would be lost to the market from in earlier phases from self-sanctioning and financial difficulties of making transfers and so on. That hasn't really happened. Russian production is down a bit, but primarily the process of diverting crude from Europe to China, and in particular India, and to some extent Turkey has gone fairly well so far. Now, that's maybe overstating things a bit, because I think these new measures are quite different, and you can see a number of areas like shipping, for example, where they could have a major impact.
Yeah, I mean, we had Narendra Tanea on the program this week, and he was talking about Indian imports of Russian crude, how they're now at 11% of India's total compared to about 1% at the beginning of the year, but that even they were concerned that they will, Russian crude exports will take a hit as a result of these shipping insurance directives. Clyde, can I go to you on that, just to take you to Europe a little bit and get your opinion on the embargo that's coming up on Russian oil, and also the price cap that the Europeans seem to still be quibbling over, but actually does it make a difference, because nobody's expecting it to be at a level where it's going to deter Russian crude flows, right? So it makes no difference.
I think the easy one to dispose of is a price cap. Yes, I haven't heard anything there that suggests that it's actually going to make a difference. Even if they did set it low enough where it might make a difference, and that price cap would then have to be sort of in your sort of 50, 55 dollar a barrel range, then you might think it might make a difference. But the other thing is, I'm quite confident, and I speak to quite a few traders, the market will work its way around this quite successfully and quite easily. It will just take a couple of months, will be disruptions for a little while, but it won't be a long-lasting thing. So any impact you see will be short-term. If you look at the other potential loss of the Russian barrels, yes, so far Russia has managed to redirect its cargoes, especially as we've said, towards China and India. That they can probably still do. There might be some more shipping constraints. I think where the greater worry is for the overall oil market is on the Russian products. I think it's going to be harder to move those around the world. I mean, Europe was a big buyer of Russian diesel. Where's that diesel going to go? Is it going to flow? Are you going to have ships carrying Russian diesel off to Asia and the Middle East, and ships carrying Asian diesel, back into Europe? I mean, that would seem to be illogical and hard to organize from a transport perspective. Are there enough ships? I talked to shipping people, and they said the answer to that is probably not. So I think your bigger worry for what's going to happen, is more on February, when the EU implements a ban on Russian products. If that is carried out, then that would be potentially much more disruptive to the global oil market. In general terms, it's hard to see exactly what's going to happen, but what we have seen from these sort of things in the past is the market's really good at working their way around after an initial period of disruption.
Peter, the markets can't work their way around gas quite as easily as oil in general. And just sticking to Europe on that front, everybody's in agreement that for this year, Europe's probably going to be okay. It's stored enough gas for what looks like a relatively okay winter, et cetera, et cetera. Next year will be the big one. We've got Germany, who's just secured a long-term LNG deal. But talk a bit about gas price outlook. We've seen, again, quite a range in the last 6 to 12 months. How's that?
Well, exactly. Oh, yeah, absolutely, Diala. Well, yes, it's cratered compared to where it was a couple of months back, and we're all understanding that, and that's been just a big washout. And as everyone's saying, it's next winter is the real cause and concern, and where we move forward over the next couple of weeks as far as Northern Hemisphere winter. And it'll be interesting. I mean, people are telling me it's starting to get very, very cool, certainly across Europe and very much into the UK. And so the draw could be quite severe. And then we're looking at, the price. I'm just looking at, nat gas, and NYMEX nat gas is sitting at around about $7.12. It's been very choppy, down from those highs of $9. So when you're looking at all those different benchmarks, it's been an incredible, again, volatile market. We've seen corrections, and we've just got to see how that all plays into over this next matter of, I'd say, 4 to 6 weeks. you can get into February and you can have supply issues again. You could have weather outages. You could have all sorts of conditions, that the unknowns that can play into this market. And we all understand geopolitical sensitivities and the unknown that impacts energy markets. So I hope we get through with by the skin of our teeth. But I'm in Sydney and it's a warm summer here, and I wouldn't like to be in the highlands outside of Edinburgh trying to keep my house warm with a limited nat gas.
Yeah, and of course, Asia can also be very vulnerable to the other parts of Asia. Robin, just back to you on the, I mean, Peter just mentioned geopolitics. I was going to get to that at the end, but let's talk a bit about that in terms of sort of China, US, Russia, just to keep things simple. You know, obviously we had Biden and Xi recently shake hands and have a chat at COP27. Putin wasn't there. What are the current dynamics around that at the moment, looking forward? You know, does the vulnerability that Xi may be facing in China have an impact on how he's approaching his dealings with the US and with Russia? We had headlines again saying China's out to support Russia, you know, so where's China, do you think, sitting at the moment? And I'll go to Clyde on that as well afterwards.
Yeah, you know, it's kind of triangular relationship, of course, or in some cases non-relationship. I think firstly that China-Russia support has been, you know, it exists, but it's been very limited. And I think China has actually been very cautious. Obviously, privately, I think regards the Russian move as very foolish and incompetently executed, but is as given kind of minimal support. And you know, you actually see the more material support today is actually coming from Iran, although that's you know, in terms of weaponry, but that's very limited in terms of practically what the Iranians can do. But we are seeing, you know, an impact of that in certain parts of the Middle East in terms of Syria in particular, and the Russian-Iranian relationship in Syria. As far as it goes to the US and China, I think, again, you know, as you said, that the meeting between the two leaders at COP27, sorry, the G20 rather.
G20, yeah.
Yes, a little bit of a step back, I think, from their confrontation. I think the moves on the moves against US moves against the Chinese semiconductor industry very impactful, and just reminding again President Xi that he also has significant weaknesses. Chinese economy has obviously slowed down enormously, and that's COVID related, but also there's major structural issues underlying that. I think obviously the danger there is if Xi decides to go down a similar road to Vladimir Putin and decide that he can take some pressure off domestically with some foreign adventurism. But yeah, I mean, I put that as a low probability happening. But obviously, if it did happen and move against Taiwan, for example, enormously consequential. But I think at least for now, low probability.
Okay, Robin, just sticking to you and talk about Iran. Let's bring that in to the geopolitics box before we leave that. JCPOA seems to be like dead in the water. You know, nobody's going near Iran with these protests now. The US apparently is just not even interested really anymore. It's got other things to think about. You know, are we going to see that revived next year, do you think? And what would it take to do so?
Yeah, it looks dead for now. And I think the Iranians have, you know, there are a couple of windows this year in February and then again in August for it to be reopened. But the Iranians were not quite willing to do enough. I don't think the current team feels itself kind of strong or secure enough to do that, or neither competent enough to negotiate their way through some of the remaining issues, and wanted guarantees from the US, which are understandable but impossible. You know, guarantees that a new administration wouldn't withdraw, which is just not politically possible. Yeah, I can't see any serious resumption of the talks now, given all the disappointments so far, and then particularly given the protests. You know, I think the Biden administration said, okay, if we have to talk to one of our adversaries, it's going to be Venezuela, which is politically less damaging, doesn't offer much in the short term, but a little bit of extra oil, and not Iran, which is more has a lot more impact, but it just isn't politically doable right now.
Okay, Clyde, can I just go back to you and talk a bit about OPEC again, just in terms of what they may be thinking from a budgetary point of view? You know, what again, this sort of at what price does OPEC, do you think, come in to defend a certain price. You know, first it was 90, now that everyone's saying it's going to be 80, where we are at the moment. You know, at the next week, we're not expecting any action, too many uncertainties. But where do you think the floor is for OPEC in terms of no matter what else is happening around the economies of the world, we're going to come in, cut, and support that price?
Well, I think that is a moving target. I think, you know, they are actually smart enough and experienced enough to know that they can't really stand in the face of a full-on global recession. I mean, if you are in a race between output cuts and global recession, recession has won every time in the past. And why would it be different this time? It probably won't. So I guess OPEC is hoping that they don't actually have a global recession to deal with next year, that the world manages to splutter along and get through 2023. And, you know, then start to see a bit of growth coming back in 24. I think it's quite obvious that the OPEC Plus people want $90 as their sort of baseline. They'd probably be happy to see movements $10 either side, obviously a bit more on the upside, but even then they'd start to get worried about, you know, the global economic impact of oil well above $100 a barrel. So I think they're looking at 90. I think it's quite clear that the major importing countries, China, which doesn't say much publicly, but you get to sort of see what they're thinking and how they buy oil. They are obviously looking more at a 70 to 75 range. The US has kind of said 70 is their floor. So, you know, I think, you know, you're starting to see a market coalesce around a sort of 70 to 90 range where everybody can possibly live, with the big question mark of, is it going to be a global recession? And, you know, if you have that, then, you know, all bets are off. But I think at the moment you sort of see everybody sort of happy to keep things in that range. And I think that possibly means that OPEC's going to roll over in December and possibly, you know, for the next couple of months thereafter as they assess how things are actually going to go. I mean, does China come back in a big way? China's had a big November. We know this. They're, you know, probably the most imports since January. But that might, you know, be more related to the fact they're exporting refined products again, rather than any strength in domestic demand. So there's still a lot of things that they have to work out. But I'm seeing that 70 to 90 range is something that looks achievable for both the buyers and the sellers.
Yeah, and certainly it's a very good price in historical standards, but of course we forget that sometimes we go up to 150. We have that survey question up for today. What is OPEC Plus more concerned or uncertain about for next year? Is it a drop in Russian production discussed this morning, or a recovery in Chinese demand? So is it you know, supply or demand that's going to influence this decision more? And you could argue it's equal, but we had our survey yesterday, which had the results up earlier now, and Chinese demand seems to be the one that's dominating everybody's concerns. Peter, let me just go back to you, talk a little bit about the US again, and I wanted to talk a bit about commodities and agriculture and other sort of commodity outlook for the year ahead. But SPR, we have an article in the bulletin today about, you know, what the US is going to do about its rebuying for its SPR, etc., with a $70 figure now being talked about yesterday by Amos Hochstein. Where do you think the US stands on that? I mean, there's clearly still movement for them to release reserves as well. So is the market taking that more seriously than it has been all year?
Well, it's new news, and new news creates interest. And when I saw it, I thought, well, you know, it would have been a lot easier to do it when it was at, you know, $30, but they've let all that out of the bag, so it's now at 70. And if they go down that pathway, that won't surprise me. So there's the first part, and I think that's what most retail traders would be taking on board, that there's a reason to do it, and it makes sense. And the second part of it is, where are we with crude prices? And maybe that's going to be that level and in that channel, as Clyde articulated, 70 to 90, and it could well fall in that. And we've just got to, again, see where we are over the next matter of months, and whether things derail. If they don't derail globally, as far as recessionary fears or really starting to bite in, or the, you know, the tiger in the tank being inflation doesn't get tamed, then where are we sitting with energy prices? And there's just, I think, a lot of uncertainty across the whole complex, certainly with the foods, certainly with the likes of precious and an unknown US dollar. So, you know, it's very, very challenging for governments and certainly challenging for traders. And that's why these short-term market movements have been so dynamic and so enjoyable for a lot of retail all over the world.
And I mean, with the Ukraine-Russia war, sort of no end in sight, really, you know, of course, there's been some victories on the Ukrainian front recently, but again, a lot of people dismissing those in the long term as not being, wow, that's quite a result.
Well, exactly. And
yeah.
No, sorry, I was just going to say, you said it is quite a result. Well, that tells you everything. I mean, that's the nervousness, you know, and again, what Clyde mentioned as far as that strong demand or what we've seen as far as November, is that going to be maintained in the months ahead? And again, you know, the fragility, all I know is that their property sector is very, very tight. It's causing much concern all across mainland China, and debt holders are very, very worried. And if that does unravel, we've been saying that it's a work in progress. If it does unravel and unravel badly, then that's really going to create much angst globally. And, you know, many, again, traders are looking at these signals to take a real deep appreciation as far as, you know, market sentiment and overall confidence across so many different asset classes.
Clyde, on that point because, you know, as you said in your opening comments, that China's showing some real intent in terms of the money it's throwing towards certain things in the economy now, a property being one of them. But the whole point is, you know, will retail buyers, if you like, can they afford to come back in and start buying again, regardless of how China's propping up the sector, if you like, in general? I mean, there's been a lot of doubt about that. And then just secondly, Clyde, just in terms, you know, do you think there's any acknowledgement, and there will be any public acknowledgement from China going forward, that it is really on a very new economic growth path going forward, regardless of COVID? Is that being acknowledged at all, and do you think it will be?
I think they start the process of acknowledging these things. They do it very slowly. Nothing in their messaging changes radically. If you look, it's all this very subtle how the authorities in Beijing start to change their messaging. So they've kind of stepped away from, you know, this absolute focus on a GDP growth target. They still have one, but it's sort of, you know, a little more fluid, shall we say. And you're starting to see that sort of messaging come out. They still want a strong economic growth, and they'll still talk about that. But I think you're sort of the days of 6% growth ad infinitum is probably over, and I think they know that. They just have to message it. As far as the confidence in the property sector goes, yes, they can rebuild that. They just have to offer enough guarantees. So, you know, a lot of the way you buy property in China is quite different than how you buy it in the Western world. So basically, the buyer takes on quite a lot of risk if you are purchasing a new property. They take on a lot of personal risk. Whereas in the Western world, you put down a small deposit. If you lose it, that's bad. But, you know, it's not going to wipe you out. Whereas in China, you run the risk of a much more serious financial consequence if your developer goes under. So I think they have to, you know, if they get that sort of thing right, where people have the confidence again, yes, I think the buying will come back. There's little doubt about that. And if you actually look at things, you know, the Chinese construction sector, we all focus tremendously on the property, residential property, and we kind of basically ignore all the other stuff, the sort of government construction property, you know, defense installations, schools, hospitals, that kind of stuff. That's actually been going very well. So if you actually look at the whole property sector as 100%, you know, it's not down as much as residential property is. The other ones have actually increased quite strongly. And you can actually see that their steel demand is down, but not dramatically. Their iron ore demand is down, but not dramatically. So, you know, it's not, the overall picture is not as bad as the media tends to portray it because of narrow focus on just residential property.
Yeah, on retail investors, if you like. Robin, let's go to you for the final comments of the morning and just talk a bit more, just back to GCC economies. They've obviously had a great year with these windfall gains from oil prices as a region. A lot of people moving here as Europe struggles and others. But I just wanted to talk to you a bit about OPEC again going forward. You know, that again back this month-to-month policy. But you know, we have had some pushback from one or two members inside the UAE and Iraq, for example, who want more production, who want to be able to sort of bring their investments that they're making to the market eventually. I mean, ADNOC just announced this week that it was raising its investment target to $150 billion in the next few years on its oil and gas. No plans there to roll back, capacity. So where do you see that unity with an OPEC Plus holding next year amongst the members? And for now, they're agreeing, but what do you think will trigger for those voices to be heard again?
Well, look, there's a growing structural tension there. I think, look, Saudi Arabia and the UAE have generally been very closely aligned on OPEC policy, but that position and also the position between the other members is going to erode. ADNOC, as you've said, is very aggressively expanding capacity. They've moved forward their 5 million barrel per day target from 2030 to 2027. They have kind of informally a 6 million barrel a day aspiration if they can identify projects to fit that. So that is by far the most aggressive growth plans of any OPEC country and pretty much any country in the world in absolute terms. Saudi Aramco plans to expand capacity too, but relatively less and over a longer period. And then you have Iraq, which has more aspirational hopes to increase production capacity. But we know those will be delayed and those will fall well short of what Iraq aspires to. And then basically all the other OPEC members or indeed OPEC Plus, they're basically stuck at stagnant capacity or in many cases falling capacity. So that kind of tension is really opening up. And when we were earlier this year, we're into steady production increases that can be smoothed over. If we go into a phase of continuing production cuts, and obviously we had one last month, and if we have a global demand slowdown and OPEC feels it has to keep cutting production, that tension will become wider, and the UAE will feel more and more that it should have a higher share of a smaller cake. And and I mean, going back to the 90s is late 90s is a bit extreme, but we have had these tensions within OPEC before where one member is very successfully increasing capacity and the others can't or don't want to keep up, and then that ultimately creates these tensions. How do the quotas get reallocated? So yeah, that's absolutely is one to watch.
That's definitely going to be come into the game next year, I suppose, although they've said the current agreement stands for another 12 months, but I'm sure that conversation will be had. Well, thanks, gentlemen. I'm afraid we've run out of time for today. We're actually going into a long weekend here in the UAE with Commemoration Day and National Day. So we will be resuming this program on December the 5th on Monday, which will, of course, be a big day, post-OPEC meeting decision and the day that the embargo hits. So a lot to talk about next week as well and look forward to. But yeah, absolutely dynamic times ahead. Thanks so much, gentlemen, and we'll see you in December.
Thank you, Diala.
Very much for joining.
Cheers, Clyde. Bye, Robin.
Thank you.
Bye.